All right. Good morning, everyone. Thank you so much for joining our multi-asset webinar today as we look out into the second quarter of 2026. Certainly had a lot of volatility to start the year. And so we will really be kind of following our standard framework here. Before we do kick off, just a little bit of housekeeping. You will see a question and answer box that you can just click on and post any questions. The idea is that I'm going to spend about 45 minutes or so going through the content and leave enough time for questions towards the end. So if there are any questions, please feel free to post them at any stage and I'll pick them up at the end. CPD points will also be allocated post this webinar as well. So with that, I mean, the framework we're going to follow today, we're going to touch on some of the big moves in markets over the last 3 to 12 months to help contextualize performance. We'll then look at asset class and portfolio performance. And then we'll spend most of the webinar looking out really from where we are standing today, touching on kind of three big themes globally, locally, and some thoughts around some points that existed before the oil shock, obviously, which is the main focus for today. And then look at how the portfolio is positioned to deliver real returns with a high level of consistency over the next 3 to 5 years. So let's kick off. Really, I mean, this has been the picture and the big driving force, certainly from a South African investment perspective, over not only the first 3 months of this year, but also over the last 12 months and longer. The external environment leading up to the end of January and even towards the end of February was probably the most positive external environment that you could ever have for South Africa. You had our largest import being oil absolutely collapsing over the last 18 months, and our largest exports being gold and platinum group metals. Those prices have really been exhibiting quite a parabolic move actually over the last 3 to 6 months. And so what that's meant is that our terms of trade have been remarkably improved. It's led to a strengthening of the rand. It's led to really low inflation, which actually allowed the Reserve Bank to drop their inflation target to 3%. It's seen really strong returns to SA equity and SA bonds, and it's really supported this positive flywheel that we've seen in terms of the broader South African economy. Now, all of that obviously abruptly came to an end following the conflict in the Middle East and a lot of the resultant moves in commodity prices. We've seen really Brent crude oil almost double in price, depending obviously which day you're looking at it, because there's lots of volatility. And really what have typically been good hedges to geopolitical events historically, things like gold, have actually taken a big markdown as liquidity was pulled from market. So we've had a complete reversal of those strong positive tailwinds. And equally, that's got a knock-on impact for South African assets and the rand as well. And you've really seen kind of following first of all, the positive move in the terms of trade, and then the negative move from kind of the end of February, the rand really acts as a release valve. And the interesting thing is we've really become accustomed since sort of the tariff tantrum in April, where the rand was close to 20 to the dollar, and it kind of pretty much strengthened in a straight line all the way actually to below 16 to the dollar towards the end of Feb. What is typically a really high and volatile currency really is living up to that name. I mean, it's been one of the highest beta currency moves, both to the upside and the downside. Last year was all about rand strength, and we saw the significant strength coming through because the external environment was so supportive. And during the month of March, the rand was obviously one of the most volatile currencies as well, selling off and retracing quite a large amount there, kind of from the lows in the high 15s to over 17.20 at one point in time, and it's come back again since then. So we're really seeing the rand act as quite a bit of a release valve in times of stress. And what we've seen, obviously, with these large step ups in Brent crude and WTI, and basically all oil and oil derivatives as well, which is certainly causing some shorter term inflation concerns. And what we've seen off the back of that in March is that not only locally in South Africa, but also globally in the US, we've seen bond yields sell off and increase quite significantly after what has been kind of quite a long period of moderating bond yields. There certainly were, coming into this year, a number of interest rate cuts priced into South African markets, priced into US markets. Throughout the month of March, those were priced out. And what you've seen is really higher real rates driving bond yields higher. And what that has meant has really been that you've kind of had equities sell off alongside bonds selling off. Now, I mentioned that earlier in terms of the retracement that we saw in gold. And I think this is quite an important and certainly an interesting call out that I find, and you can imagine the read through to broader portfolio construction considerations, is that where you had gold acting as a risk off asset and a portfolio diversifier in March and April last year around Liberation Day, there you can see the S&P 500 was off over a couple of weeks, about 8%. In the first 3 weeks of April last year, gold was up about 10% over that period. So it was acting as its typical sort of portfolio diversifier. Now, last year was all about the debasement trade, and precious metals caught quite a big bid. We were in a period of really excess liquidity in markets. And what you had is you actually had kind of this negative correlation and diversifying properties of gold actually kind of morph and saw gold actually start acting a bit like a risk-on asset. So when equities rallied, gold rallied, and it was kind of this representation of really loose financial conditions and gold being a beneficiary of excess liquidity in the system. With the higher real rates coming through in March, we certainly saw the shine come off gold. And as you can see with the Iranian conflict and geopolitical risk, that gold actually sold off 15% over March, while S&P 500 was down about 8%. So actually what was this great diversifying asset class actually lumped in and added to the positive correlation that we saw between equities and bonds, which meant during March there was really very few places to hide from a diversification perspective. I mean, here I've pulled up kind of 3 different groupings. On the left-hand side, we've got SA equities and SA bonds. And what that chart is showing you is basically kind of rolling 3-month correlations. If the number is positive, then that shows you that the 2 asset classes typically increase and decrease together. Whereas if they are negative, then it typically shows kind of a diversifying property. And what you can see across the board, whether that's SA equities and SA bonds, SA equity and gold, global equities and global bonds, you basically have some of the highest positive correlations between all of those asset classes as at the end of March. So really looking back over the 3 months on a year-to-date basis, which has meant in multi-asset portfolios, it's been very difficult to embed diversification. What has really worked? Well, it's pretty much been, from a South African investor's perspective, really either dollar cash or energy exposure in portfolios that have really provided that negative correlation. Or alternatively, if you've held higher weightings in things like cash or shorter duration bonds, you've been able to dampen portfolio volatility. So whereas there were places to hide in kind of April last year, through the month of March, there weren't that many places to hide. And that's, as a result, what you saw is quite a significant sell-off in March. The good news is, however, is that most asset classes only really retraced to where they were at the start of the year. So when you look at a 3-month snapshot of a year to date, it actually covers over and smooths over a lot of sort of the day-to-day volatility that you would have seen, because January and February were actually really strong months for a lot of asset classes. And we saw sort of gold push on to new highs. And so what I've shown here is just really that 3-month snapshot for you to get a sense of how significant that volatility was. All of these asset class returns are in rands, and what you can see from sort of 100 rand at the start of the year through to the end of Feb, you can see things like EM equity and SA equity were up over 10%, which is a significant move in just 2 months. You had things like SA bonds up almost 5% over just a 2-month window. And similarly, you saw kind of quite strong performance from global bonds. And then throughout the month of March, you can see that all asset classes sold off really together, and there wasn't really that much place to hide. Obviously, those asset classes that had done better on the way up took a lot more heat on the way down. So things like SA equity were off kind of at one point more than 10% during the month of March, and you saw a big retracement from South African bonds as well, off around about 8% during the month of March. But given that strong performance up in Jan and Feb, the quarter-on-quarter change is not that significant. So when we look at that asset class performance, the last 12 months since the lows of Liberation Day, if we think back to the base of the last 12-month period, a lot of volatility in markets in March and April last year. And off those lows, we saw really strong returns to most growth assets. Interestingly, over the last 12 months, it's really been developed market equity and actually primarily US equities that have actually been a laggard, and set against an environment of broader dollar weakness. We've seen strong returns to commodities, emerging markets, and within that, obviously, South African equities being one of the best performing asset classes over the last 12 months. And really strong returns, equity-like returns from SA bonds as those yields came in significantly over the last 12 months. And really, it's been global bonds and cash, given the rand strength over the last 12 months, which has kind of detracted from portfolio performance. However, those were kind of the asset classes, sort of global bonds and cash. SA cash also performed relatively well. That actually helped buffer some of the volatility in the 3 months, and certainly during March of this year. And you can sort of see the round trip over a 3-month period to things like SA equity, developed market equity, whereas more interest rate sensitive sectors like SA bonds and SA property taking a little bit more pain over the 3 months to the end of March. So what does that mean for portfolio performance? You would have known, kind of given many of the compressed risk premiums, we have been slightly more defensively positioned over the last 12 months. And that was really based off 2 reasons. You could still generate pretty sizable real returns being defensively positioned without investing in excessively expensive asset classes across the board. So given that slightly more defensive positioning and given kind of the strong returns that we saw across asset classes, we had slightly softer returns over the 1-year number. However, you can see the diversification and the strong performance versus the peer group kind of pulling back about 2.7% through the first 3 months of 2026. So ultimately what we're talking about there is generally a much smoother journey getting to a similar destination at the end of the day, roughly just marginally ahead of the peer group over 3 years, and strategy really delivering strong returns over 5, 10 and 15 years after fees versus the peer group. This is just kind of to zoom in over what has been a really quite tumultuous 2025 and start to 2026, just to give you a sense of kind of how the 10x Your Future Fund has performed versus the peer group average. What we've done is we've kind of mapped out from Jan 25. The blue line there is obviously the performance of the future fund, and the purple line is really the broader multi-asset category average. And what you can see is actually the return over the 15-month period where we've kind of been exposed to all of this sort of global geopolitical volatility has actually been exactly the same. Kind of the starting and the ending points have really been exactly the same. But what you've seen is a much smoother ride through the 10x Your Future Fund, given kind of the diversification and the lower risk that we've taken on. And that's come through and evidenced in kind of those upside and downside capture ratios. So we've kind of, when the category's gone up, we've captured about 85% of that move up, but we've only captured about half of the move down on the downside. So really kind of delivering better risk-adjusted returns, much lower drawdowns, and lower volatility as well. And given obviously some of the snapshots over sort of a 12-month period, or that we've seen, given the starting point of the tariff shock, I think it's quite important to understand the point that what we're looking to do is deliver consistent real returns through the fullness of the cycle, and help investors stay invested to achieve their long-term investment goal. So that's kind of everything in terms of what's happened. Looking out, obviously the geopolitical shock and what's happened with oil is a big talking point. We obviously are not in the game of trying to forecast where oil's going to go or forecast when a ceasefire is going to happen. It's incredibly difficult, and it's not a good basis for making investment decisions. But what we try to do is we try and look at what the market is pricing today, and where one is being paid for taking risk and where one isn't being paid for taking risk, and how we can build a portfolio today to deliver returns more consistently through the fullness of time. So jumping into kind of the first point here around oil, and I think this is an important point to make, is that when you look at things like tariffs from Liberation Day, it was very much a one-sided event. Kind of whatever Trump said he could put tariffs on, he could take them off. There was no dependencies on other role players, and so this sort of tuckoing became quite a common thought, where whenever the point of pain was too high, Trump would just roll back his initiatives, and the market would see these relief rallies come through. And we've seen kind of a similar story play out with some of the geopolitical risks in Iran, and we've seen how Trump has obviously been very bullish in terms of being pretty aggressive, threatening to destroy infrastructure, and then very quickly walking that back as we see market pain coming through. The reality, however, is that when one looks at things like the oil market, it's purely not just a financial market. There's actually a physical market. And given the physical supply disruption that's happening, it will take some time to, regardless of how long it takes to resolve the conflict, there will take some time to get the actual physical supply of oil back to the same levels that there were. And that has knock-on consequences in terms of feedstocks to broader energy supplies, and knock-on consequences as that works through the economy. I mean, from a South African perspective, the move that we've seen in terms of the fuel and diesel prices this month, we're going to see, and we set for another big increase in fuel and diesel prices next month as well, is probably the best way to understand that, and then a result of what the knock-on consequences for inflation might be. But because there is physical impact here, and we've seen about a 90% reduction in sort of transits through the Strait of Hormuz, even though there might be releases of oil from strategic reserves, rerouting via new pipelines, there is going to be a longer-term tail and impact in the physical market relating to oil. Now, the big question I think that's important is, how high is too high for oil? So what we're looking at here is really a chart back to the 1970s. And what we've tried to say is, okay, well, let's look at global GDP. Let's look at global crude oil spending and understand kind of what percentage of global GDP crude oil spending makes up, to understand, okay, well, where have there been historical pressure points, or where are things actually low enough that the broader economies are able to cope. And what you can see here is really kind of about a $200 oil price would be on par with other really high extremes that led to significant demand destruction. So obviously we're not quite there yet, and we've seen quite a big retracement in oil over the last couple of days. But kind of a sort of a medium risk scenario of about $140 a barrel oil would be towards the upper end of that sort of broader threshold. And where we're sitting at the moment now is actually going back over the last 50 years, roughly kind of in line with sort of that mean threshold. However, it's much lower than what we've become accustomed to over the last 10 years. And so one needs to think about the impact of these higher prices. Why? Because ultimately, one is obviously the inflation pass through, but ultimately, higher oil prices can be thought of as a tax ultimately on the consumer. You need to pay more money at the petrol pumps. It means you have less disposable income to pay elsewhere. It ultimately is a knock on real incomes, and that ultimately can lead through to lower consumption growth. And lower consumption growth obviously can have a big knock-on impact in terms of broader economic growth. We know that the consumer makes up something like 70% of broader US economic growth through time. That's obviously been slightly augmented by the capex build out currently. But that's really the big key, is like how high is too high for demand destruction. We don't quite appear to be there, but one obviously needs to know that we certainly haven't got to any sort of long-term sustainable resolution yet in terms of what's happening. When one looks at oil prices, there are lots of different prices quoted for oil. Now, typically these trade via futures contracts, and so you'll see things like dated Brent, which is the price of oil for immediate delivery, got up to as high as sort of $200 a barrel at one stage during March. The most commonly referenced future is the near-month future, so the one-month future. And here what you can see is I've showed what that futures oil curve looked like at the end of Jan versus what it looked like at the end of March. And what you can see is that CO1, which is the first month future, increased significantly from about $70 a barrel to about $120 a barrel. But as the market kind of looks out further over kind of 2, 3, 4, 5, 6 months, 7 months out, what you can see is that futures curve actually kind of falls pretty quickly back down to $80 a barrel. And if you look out over the next 12 months, what you've really seen the impact in terms of the futures curve pricing is really from $70 a barrel, a pretty flat curve that we saw at the end of Jan, to something like $80 a barrel. So the market's certainly looking at this as really pricing near-term delivery risk and supply risk around future, but not really any longer-term impact in terms of market pricing yet. So how we can think about the read-through into asset classes is really that certainly the oil commodity market is not pricing in prices materially higher for much longer at all. Now, it's quite interesting if you look at the read-through from the inflation risk, obviously, around higher oil prices. Typically, if there's higher inflation risk, that would normally elicit a monetary policy response. And that's ultimately what we've seen, is we've seen interest rate cuts being priced out. Here we're looking at the US curve on the left. What the chart at the left is showing you is the blue line, that's light blue line, that stepped, looks at your effective Fed funds rate. And what you can see is we've been in quite a big interest rate cutting cycle, really going back to August 2024, where we had a number of cuts in the back end of 24. Then through most of last year, interest rates were paused. And then really from September last year, again, we saw 3 interest rate cuts. And what the darker blue line shows you is it shows you the market's implied interest rate for Fed funds as at Jan 2027. And what you can see is at the start of the year, and even through Jan and Feb, the market was pricing the Fed funds rate to be around 3% in January next year. And it was sitting at about, and it is, should I say, rather sitting at about 3.25%. So you can see there that really by Jan 27, there were almost kind of 3 interest rate cuts being priced in. And what's happened throughout March is that all of those interest rate cuts have been priced out the market, and now the market's kind of really expecting interest rates to be unchanged over the next 12 months. And what that repricing of interest rate cuts out the market has done has really pushed real rates higher in the US. So the chart on the right-hand side looks at the US 10-year, and it decomposes the US 10-year yield between break-even inflation and the real yield. Here I've actually put the break-even inflation at the lower half of the table to show you really how those long-term inflation expectations have pretty much been completely unchanged. There's no pricing in of higher inflation risk looking out over the next 10 years. Really, the sell-off in yields and the backup in yields that we saw was really from a much higher real rate perspective, which actually creates some opportunities when one thinks about the entry point for allocating to global bonds from this point. And really, the question around, is there demand destruction ahead? Well, what we're looking at here are kind of two different points on the market's pricing of future inflation. So we've got the 2-year inflation swap, so kind of short-dated inflation expectations. And what you have seen in March is a tick up in short-dated inflation expectations, even though long-run inflation expectations have been pretty well contained. And then if you look at kind of what the market thinks 5-year inflation will be in 5 years' time, what you've actually seen is that those longer-term inflation expectations have actually come in quite significantly. And what you can kind of infer from that is that maybe there's going to sort of be a short-term sort of blip in initial inflation, but that might actually lead to demand destruction over the longer term, given kind of the tax-like effect of higher oil prices and what that might mean for broader inflation longer term is actually that demand destruction might lead to kind of deflationary impacts later on. So certainly no embedding of inflation expectations here. And really, I think off the back of higher real rates, question really needs to ask what happens to economic growth going forward. And the move really that we saw in March and the sell-off in US equities was really just a response to those higher yields than it was any impact to the underlying fundamental strength in US equities. So what I've pulled up here is really just looking at the period of March, which was the volatility in the S&P 500. And what you can see is that dashed line is the S&P 500 price. You can see it recovered pretty strongly in the last 2 days in March as there was sort of a little bit of tuckoing coming through from Trump. But regardless, it sold off from about 6,900 all the way down to 6,300 at one stage. So kind of, let's call it a 5 to 6, 7% sell-off, depending at what time you're looking at that. But at the same time, US 10-year real interest rates have gone from 1.7, which is the sort of royal blue line, to over 2%. And so when you look at this through like an equity risk premium lens, what you can actually see is that the equity risk premium through the month of March actually reduced. So what you can say is even though US equities sold off, they actually became less attractive relative to bonds, given the backup in yield. So it's really that higher interest rate feeding through to the discounting of equity valuations. And really, it was a repricing effect to higher yields that we saw in January rather than any breakdown in underlying fundamental earnings assumptions. So really that sell-off was about rates. And over really the last 2 weeks, we've obviously seen a big retracement of that. S&P 500 we saw hit pretty close to all-time highs last night, back up above 6,900 as well. So really there's been kind of this big sort of risk on trade over the last 2 weeks as the market is starting to discount a resolution to the challenges and the volatility coming out of the Middle East. What we've got here, we're looking at 30-year real yields in the US, and I just want to call out that at the end of March, kind of close to 2.7, 2.8%, those are the highest 30-year real yields that we've seen in multiple decades. So actually kind of the backup in real rates rather than inflation expectations is presenting quite a good opportunity for entry into global bonds as an asset class, given the underpin of these much higher real yields that we're seeing. And that's kind of a positive, I think, of some of the volatility that we've seen certainly over the last 3 months, is that you really are starting to see some of the best entry points for global bonds that we've seen going back over multiple decades. So really, I think kind of wrapping up, I think some of those global observations, oil price shock is very much a physical supply shock, which is real and it's unresolved. So even though we've pretty much seen a retracement in financial markets, we still need to work through the impacts of the physical supply shock of a reduction in physical delivery of oil, leading through to those higher oil prices, and what that means for inflation working its way through the economy, not only directly through oil and petrol and diesel, but other offtakes like fertilizer and the impact that may have on broader inflation. We've seen a pricing out of rate cuts, which has led to higher real yields longer out the curve, while longer-term inflation expectations have actually remained pretty well anchored. So the market's not really pricing any long-term inflation risk here, which is something to consider. And really, the equity market sell-off that we saw was really just a response to higher bond yields than it was to a breakdown in longer-term fundamental growth and the read-through to earnings there. And where we're sitting now is that actually equities, despite the sell-off at the end of March, were actually less attractive relative to bonds through a longer-term framework. And those higher real yields are really presenting a good entry point into global bonds. Okay, so that's kind of the global picture. If we take that through as a read-through to what this means for South Africa, I mentioned kind of obviously the moves in terms of the different commodity prices, our big exports being gold and platinum group metals, big imports being oil. And this actually looks at the terms of trade index. And what you can see is really from the lows at the beginning of 24, South Africa's terms of trade have improved dramatically. And that's been that big underpin to kind of the positive flywheel in South Africa. The external environment, things that we don't control, i.e. the broader commodity markets, have been so supportive for the broader South African economy that it supported South African assets quite significantly, both equity markets. It's seen a big reduction in our bond yields, seen a massive improvement in the fiscal trajectory of South Africa, and has been an underpin for broader recovery in our economic growth. We've seen a sharp retracement of that over the first 3 months of this year. However, if you look at a baseline there, we still actually are operating from pretty elevated levels. If we look back over the last 5 years, I kind of draw a straight line from the end of March. It gets us back to about September 2025. So that can be read in kind of two ways. If we kind of seen a movement in commodity prices sort of halt at this point, see kind of oil continue to subside as we've seen over the last couple of days. We see gold prices and platinum prices continue to kind of increase, or at least not sell off any further. Well, we're probably in still a pretty good place from a South African perspective in terms of the global picture. However, if we see precious metals prices continue to sell off from these highs, if we see oil prices stay at these elevated levels for slightly a longer time period, what we could have is a further deterioration in these terms of trade, which obviously creates significant downside risk for things like the Rand, South African equities, and South African bonds. So again, it's not necessarily things that are in our own control as a country, and often it's dictated by what happens externally that has a bigger impact on what happens to the actual South African economy, which we know is quite a small economy. It's an open economy, and it's very exposed to global trade and global growth. And so that positive external environment, combined with some structural reforms that we're seeing from a South African perspective, certainly saw this positive flywheel happening in South Africa. We saw the end of load shedding. We saw an improvement in logistics in our ports. And that happened at a time when inflation was materially lower, and we were able to earn a lot more for our exports from higher gold prices. spending a lot more on our imports, a lot less on our imports for Brent crude, which saw inflation collapse, which saw the Reserve Bank then take the big move of looking to reset our inflation target lower from 4.5% to 3%. And the market immediately gave them the benefit of their credibility, given that they're such a credible central bank in terms of how they manage monetary policy. And that was another positive kick in terms of the flywheel. Why? Because it brought down our government bond yields dramatically, which means that the government's able to finance its debt at a much lower level, which improves the longer-term debt to GDP trajectory. It improves the amount of money that we spend on servicing interest costs, and it makes South Africa a better borrower globally, which further leads to lower rates, which leads to further lower cost of capital in the South African economy, which can stimulate broad economic growth. So that's that positive flywheel, and that was certainly in effect, really, I would say, since the elections that we saw, positive elections that elected the GNU a couple of years ago. And where you can really see that coming through quite significantly is if we look at 10-year real rates in South Africa, they were touching at kind of 5.25% in July last year, and they fell really significantly to actually kind of below 4%, sort of about 3.80 at one point in time towards the end of Feb. And that's at materially lower cost of capital, which creates a much more fertile environment for economic growth and really continues on kind of the positive flywheel from a South African perspective. With the sell-off in commodities, the reversal in the terms of trade, what we've seen is obviously a big kick up in those real rates again to about 4.5% at the end of March. They've come in again a little bit, but really the global environment is kind of putting that SA positive flywheel on pause. And we're certainly seeing that in terms of the reaction function from the Reserve Bank. So at its meeting in March, it laid out a couple of different scenarios. Kind of a baseline scenario is that Brent crude averages at about $80 a barrel through to the end of the year. That Rand is stronger than where it was in March. That is a swift conclusion to the Middle East. And that'll see a kick up in inflation, what they're modeling at about 4.3% in April. And if that's the scenario that plays out, they still see a gradual easing and rate cuts through to the end of 2026. This is just a very quick blip that we get over. However, if the conflict continues out over a couple of months, sort of the 2-month conflict, and the reality is we are now in the middle of April, so this is becoming more and more like a kind of a central base case, is that oil hangs around about $100 a barrel. You've got a slightly weaker rand. You're going to have a sustained breach of that 4% upper band target of South African inflation through this year. And given the lower inflation target, what that means is that the Reserve Bank actually needs to be pretty reactive and hike rates in that environment. Whereas if they were sitting at the old inflation target, it would have allowed them more room to look through this inflation cycle. But given that they want to ensure that they credibly land the 3% target, what it means is in response to these global shocks, they have to hike rates slightly more aggressively. And if we actually see this conflict as being more prolonged with kind of higher than $100 oil prices, a materially weaker rand, and potential breaches of a 5% inflation in South Africa, which, remember, just a couple of years ago used to be our baseline expectation. There's a good couple of hikes that the SARB is actually expecting in that environment. So if we take that kind of SARB scenario analysis and overlay what we're seeing from a market pricing perspective, well, here again, I've overlaid the repo rate in South Africa, and I've overlaid basically the market's expectation of what 3-month interest rates will be in 9 months' time. So if we are now in the end of March, beginning of April, 9 months' time will be December. What will 3 months interest rates be then in December this year? And what you can see is that the market was forecasting about 2 interest rate cuts towards the end of Feb, and that has now swung all the way to more than 2 interest rate hikes. So the market is acknowledging the SARB's reaction function, and that has led obviously to the backup in bond yields from a South African perspective during March. And so we've had much higher real yields from a South African perspective in March, from that kind of 3.8 to about 4.5. Equally, at the same time, as broader break-even inflation widened significantly. So break-even inflation for the 10-year part of the curve was sitting at about pretty close to 4 at the end of Feb. That widened pretty much close to 5 at one point during March, kind of settling at about 480. And so what that means from compared to the end of Feb is you're being paid a much higher real yield, and you're being compensated for much higher kind of inflation risk through owning nominal bonds. So relative to where we were at the end of Feb, kind of SA bonds are starting to offer a little bit more value given what the market is currently pricing. So, I mean, just summarizing again from an SA perspective, we've obviously seen a reversal of the positive commodity tailwinds from last year, and a big hit to our imports and our exports after a long period of positive strength. That kind of is putting a pause to the positive flywheel from a South African perspective. And that can be very easily seen through the pricing out of rate cuts into rate hikes. But given that how that's transferred to the broader bond yield curves in terms of higher real yields and a much wider break even, actually the widest break even since kind of about June last year, there are some more opportunities in South African fixed income. And I would say, I made this point kind of earlier on, but this is a bit of a risk for portfolios that are all in on South African assets, is that South African equities, South African bonds, and the Rand are all highly levered and sensitive to what happens to these commodity markets and commodity prices, primarily gold, but also what happens to oil. So even if you are well diversified across South African equities, South African bonds, and have very little offshore exposure, you might think you're diversified, but actually you've got the same risk that's actually embedded across all of those asset classes. And that's really what happens with commodities, and the external environment will dictate what happens to those major SA asset classes going forward. So you want to think about the diversification that you're embedding in portfolios from this point. And I think it's important to also just take a step back. If we didn't have this oil shock, if we didn't have the geopolitical risk in the Middle East, like, where were we from a market perspective? And I think there it's quite important to step back, and where we came into the start of the year, really market expectations were exceptionally high. Earnings growth in the S&P 500 was expected to be kind of 15 to 16% this year, 15 to 16% next year. Inflation was expected to glide down to 2%. There was an expectation that real GDP growth was going to be pretty strong at 3%. And now we kind of roll forward, and obviously that's all been upended by what's been happening in the Middle East. But markets were priced for those very favorable outcomes coming into the start of the year. And there hasn't been a significant change in that market pricing, despite the volatility that we've seen during March. It's really just reversed some of the moves that we saw in January and February. So one needs to look at this. And so when we look at US equity markets, what I've just brought up here is kind of the longer term realized earnings growth trends. And so going back to 2016 through to the end of 2025, you've had nominal earnings growth in the US of about 9.5% per annum. Looking forward into 2026, that's set to be increased by analysts are expecting an 18% growth in earnings for this year, and a 16% growth in earnings for next year, so 2027. Now, what that means is that the expectations are really already very elevated, and it just creates a higher hurdle for expectation beats. Because what really drives markets is not markets delivering on expectations. It's if there's a mismatch or a gap between what was expected and what actually happens. And that's what drives the big moves in markets. And where we're sitting today is that the expectations are exceptionally high. So it becomes much harder for US companies to beat those expectations. And there is a risk that they might not meet that exceptionally high bar. And if that happens, that potentially can come through in market pricing. Now, what's quite interesting is when one looks at valuation metrics and forward valuation metrics that say, what's the valuation of equities today, given consensus earnings expectations out over the next 12 months? There's certainly an argument that's been made today that actually you're seeing some of the most attractive valuations in US and US technology that we've seen, some of the most attractive that we've seen over the last 5 years. What that factors in, however, are those really robust forward earnings estimates. And if you look out slightly further, the chart on the right-hand side really actually shows you long-term earning growth forecasts that are embedded in today's valuations. And you can see broader S&P 500, kind of those long-term earnings growth forecasts. Here we're talking 3 to 5 years out, and these are analyst expectations, are sitting just kind of below 20%. When you look at kind of technology sectors, you're kind of just below 30%, and semiconductors kind of over 40%. Now, those are the expectations that are already baked into prices. And so these lower forward valuations that you're seeing in the chart on the left-hand side can be interpreted in two ways. Either it's a great entry point to invest in these asset classes, or it's the market saying, you know what, analysts, you might have these strong forecasts looking out over the next 3 to 5 years. But as the market, we are actually starting to question whether those strong, really bullish earnings forecasts are actually sustainable over the longer term. And what you typically see is you'll typically find the market will sell off long before analysts will reset any of their earnings expectations lower. That's just a function of the market. You'll only ever see analysts mark down their earnings expectations when the markets have already rolled over. So just again, pointing out to those really elevated expectations that are baked into market. A lot of that has been driven by the CapEx build out. You would have seen this chart doing the rounds in multiple places. I mean, you're seeing really significant numbers in terms of CapEx spend, and the market's starting to question some of the ability for these hyperscalers to monetize the significant CapEx that they're doing. I think a very important point is the chart on the right-hand side, is that historically, all the growth from these hyperscalers has been funded out of their own cash generation cycle, where we're starting to see significant debt issuance to ultimately fund that CapEx spend. But equally, as all of that cash flow gets removed, where you can see the estimates for this year is that hyperscalers CapEx will be close to pretty much 100% of their cash flow from operations. It makes these businesses much more heavy from an operational leverage perspective, a lot more sensitive to broader economies, given that they no longer have these very heavy cash generative businesses that can continue to buy back their shares because they're now just pushing that all to CapEx. They will be forced in a year or 2 years' time to actually evidence the return on that CapEx. And that's where the big question currently exists. AI and most people are now familiar with using these tools is absolutely revolutionary. However, are these businesses going to be able to generate enough profit to generate a return on this CapEx? That's the question that markets are struggling to ask. And set that aside, despite the volatility that we saw in March, the equity risk premium across markets, whether that's South Africa, whether that's the US, whether that's UK, whether that's Europe, are pretty much at multi-decade lows. So as investors looking out over the next 3 to 5 years, asking, really, how much am I being paid for taking equity risk today relative to bond risk? Well, it doesn't matter which market you look at. It's the most compressed that we've seen, really going back to kind of 2009, probably 2007, 2008. And actually, even if you roll through that period, the only really parallel is kind of 98 to 99 to be at these compressed levels. And equally, what you're seeing is kind of the US is a poster child for those expensive valuations, but you're seeing the same picture now kind of in Europe. You're seeing the same picture across the world. Growth assets relative to defensive assets are the least attractive they've been in many years. I'm just keeping an eye on time, seeing we're running pretty short here. This was quite an interesting move. I think certainly it was catching a lot of attention in February before the geopolitical risk. Certainly, there were headlines doing the rounds at one stage that software was dead. Claude and Claude Code basically replacing developers, replacing a lot of software as a service businesses. And you saw the S&P 500 software sector sell off dramatically, really about 25% from the start of the year through to the end of February. Now, what's quite interesting, and we previously over the last two webinars since last September, we've kind of been flagging some of the risks in the private credit space. They've certainly come to the fore and certainly catching a lot more attention in the last month or two. But what you can see is that the listed proxy for private credit has sold off alongside a lot of the concerns that you're seeing in the software part of the market. One, it's kind of an impact of disruption from AI. AI is not only kind of positive, it also has the big impact of potentially disrupting many of the incumbents. And equally, if you think about where many of these loans were originated, it was really out of the lows of COVID in 2020, 2021, maybe 2022. You had interest rates pretty close to zero. You had significant fiscal spending, and you had this big pull forward of demand into online businesses because everyone was trapped in their homes due to lockdowns. And so you saw the significant financing of many of these businesses with kind of a 5 to 6 year tenor. And you know what? Where are we now? 2026, we're pretty much at that refinancing point for many of these businesses. And either they have to start generating significant profit to pay for the cost of financing, or they need to exit to other businesses. And with the advent of AI and the ability of AI to augment software development, many questions are being asked: will these businesses be able to actually exit, or will they be able to generate sufficient profit? And so there's a lot of leverage creeping into the system. The other thing that I think is quite important is that we're starting to see private credit concerns morphing into sort of asset liability mismatches. What do I mean by when I say that? Private credit as an asset class, it's typically illiquid, but investors are trying to seek liquidity. And certainly you saw this come to the fore in the first quarter of this month. What this chart looks at is really a lot of the popular private credit funds. You'll see lots of names you're familiar with there: Blackstone, Apollo, Oaktree, KKR, Goldman Sachs. And the requested redemption amounts from investors ranging from everything from 7% to 40%. Now, the reality is most investors in these asset classes are being gated to only allow, with these funds only allowing investors to withdraw 5%. And that's in place because if you had to have 40% come and request to get their money out, these funds would have to sell these illiquid assets and realize marks that are much lower. And actually, typically what you have from private credit is really this really attractive return profile of pretty much an accrued straight line return. And you see very little volatility because there is almost no mark to market of the underlying asset classes. And if you see continued redemptions out of these funds, it will lead to kind of forced sales of the underlying illiquid loans, which would lead to significant markdowns from a mark to market perspective, which is obviously where significant risk lies. And just to overlay that is to say, well, there's certainly signs of risk in credit markets. But when you look at liquid credit market proxies, Bloomberg high yield spreads are pretty much back to, if we rolled forward, this is to like the yesterday, are pretty much at the lowest levels seen going back again over the last 25 years. So what are we saying? At this point in time, there are multiple risks on the horizon, whether that's from disruption from AI, whether that's from questions around the ability for companies to monetize their AI spending, whether it's from stresses in private credit. But what you've got is you've got equities that are the least attractive relative to bonds in the last kind of 2 decades, and you've got credit spreads that are the tightest that they've been going back pretty much over the last 30 years. And so the risk premiums are exceptionally thin, and investors aren't being paid or compensated sufficiently for taking on lots of risk at this stage of the cycle. And so risk premiums are very thin. You need to think about how and where you're taking risk and what you're being paid for taking those risks. So quickly, just to wrap up here, I'm cognizant we've actually kind of running a little bit longer than we wanted to. There's a lot of ground to cover today. We look out over the next 5 to 10 years and we say, what are we being paid to invest in different assets across the board? We're looking at real return, forward-looking numbers from today's starting point, certainly at the end of March. And what you can see is that the prospective returns in terms of those bars, as well as the long-term average returns, which are the dashes. And the biggest disconnects here and the key takeaways is that all defensive assets, whether that's local or global, are offering better returns than they have through kind of the fullness of time. And most growth assets, doesn't matter whether you're SA or US, EM, DMX US, are offering pretty much lower returns on a prospective basis than they have through the fullness of time, with the biggest disconnects really being in US equities. And what that means for our portfolio positioning is that we still remain relatively defensively positioned versus a through the cycle benchmark of 70% growth assets. We're sitting at about 64% growth assets. The biggest underweights there really come from a US equity exposure. We used the backup in real yields and nominal bond and break-evens in the South African market to close our underweight to South African bonds. We still are underweight, and if we have a further backup in yields, there will be able to add more to SA bonds given the sell-off that we saw. But in aggregate, if you sum together SA bonds, SA ILBs, and SA cash, we significantly overweight SA defensive assets given the high real yields that are on offer across those asset classes. And we've also been increasing our exposure to global bonds, giving a backup really in longer term real rates that we've seen there. But we don't think that this is the right time to go right out along the risk spectrum and the risk curve, because risk premiums are very thin. You're not being paid to take a lot of risk from this point in time. And equally, you need to think about, if you are taking risk, what diversification have you embedded in your portfolio? Because what we are seeing in risk-off periods and what March really illuminated is that precious metals, bonds, equities, all the correlations tended to one, and there were very few places to hide in terms of managing those risks. So you need to think about diversification in an environment where risk premiums are so thin. Equally, we don't think you have to take significant risk to generate real returns for clients. Think inflation plus 4, inflation plus 5. You're getting that from South African bonds. You're getting decent real returns from South African cash and global bonds as well. So no need to go out the risk spectrum. And we remain relatively defensively positioned with the objective of delivering consistent inflation-beating returns through the cycle. And given our current positioning, what you can expect is if you see continued volatility in markets, the portfolio should hold up pretty well in those periods of stress compared to what you may find in many other multi-asset portfolios. So that's, I see we've hit 12 o'clock. We haven't necessarily had any time to touch on questions, but we will get back to you because I can see there have been a number of questions that have been posed. If you do have any other questions, please do send them out. And once again, thank you so much for joining us. I wish you all the best as we move into the second quarter of 2026, which is undoubtedly going to be a period of continued volatility. And until we talk again at the end of the second quarter, beginning of the third quarter, I wish you all the best and we'll chat soon. Thank you so much.